Okay, everyone. Thank you for joining me, Tony, from Macro Ace, and also the head analyst at Financial Juice. Thank you very much for joining us. We'll go through the expectations for CPI, what's happened in the past, what is the current sentiment surrounding it. But yes, why are some people saying CPI data is leaked? It's not. All right. Well, take that with a pinch of salt, whoever said that. All right. So US CPI then. Let's get into it. So don't forget to share this video with your fellow trading friends, anyone who would be interested in understanding the economic release and getting more knowledge about it. So US CPI then. So what is it? So what it is, it measures how much consumers are paying for retail goods and services. And the way it's measured is also why it's a very big release as well, because there's a lot of actions that are taken to measure inflation within the US. So they measure 26,000 retail outlets, 4,000 housing units in 87 urban areas, and prices are collected on 80,000 goods and services as well. Okay, so that's quite a bit that is done from for the US CPI. Remember, you have agents that will go out to the shops to get a very accurate read on price changes. Sometimes what they will have to do is they'll have to kind of give a little bit of a guesstimate as to see how much prices have changed. But this is a very accurate piece of data that is provided by the US, by the government. So key measurements then of what make up the CPI report. First of all is housing, that makes up 42%. Food and beverages, about 14%. So just kind of as I kind of carry on with this here. So these are the recent or up-to-date weightings of each measurement within the CPI report that I had checked. Transportation represents about 18% of the report. Medical care, 8.5%. And then also, if we're looking at the core CPI, excluding food and energy, that's what that means there. So, of course, we know that inflation has been driven largely by energy prices within the first half of the year. Now it's more so food prices that have seen a big increase. We'll go through the previous release to kind of give you a bit more detail into that there as well. But of course, the core CPI data is of course going to have a big difference compared to the normal, the non-seasonally adjusted data that we have for the year on year, and then the seasonally adjusted data for the month on month. If we're looking at why the month-on-month data is the most preferred, it's first of all, it's a headline figure within the CPI report for the month-on-month. Okay, and it also shows you it's also the preferred measurement for the for the government as well, and also traders too, because it shows you what's going on within the economy now without the effects of weather and production cycles and etc. So that's why it's the preferred measure to look at in inflation within what's going on in the short term. But of course, when we're in a central bank tightening phase or easing phase, then all the bits of data from the US CPI have a very, very strong will have a very, very big effect on not only the US economy, but also the markets as well. So that's what the current situation that we're in at the moment within the US, and that's why we're going to be focused on all the bits of data, not just the month-on-month and the year-on-year, but also the core month-on-month and core year-on-year as well. Then if we look at what is the difference between PCE and CPI, so the key thing is that PCE places a low weight on prices of gasoline or residential rents, which CPI has, which is a part of the reports in the CPI report and has more of a weighting compared to PCE. The other thing is that the CPI only measures, as said, urban area inflation, right? The PCE price index measures inflation across the US as well, whether it be urban or non-urban. So that's one of the key differences as well. And then finally, the other key difference is that the CPI measures a fixed basket of goods for at least 2 years, right? So whereas PCE can kind of chop and change to look at what it measures, So for example, if chicken prices are really expensive and people are actually buying, let's say, beef, then what the PCE price index will do is it will look at beef prices rather than chicken prices. The CPI would stick to looking at chicken prices rather than chopping and changing, saying, okay, hey, we need to look at beef prices instead, because that's what people are looking to buy more of. So that's the other key difference between PCE and CPI, which the Federal Reserve likes to look at the PCE price index because it gives them a better understanding of where inflation is at the moment, and then they can make their forward guidance from that. Then carrying on, so then as I will look at the previous report as well. So what we've seen in the previous report, so the gasoline index fell 7.7% in July, and offset increases in food and shelter indexes, resulting in all items index being unchanged over the month. The energy index fell 4.6% over the month for gasoline, natural gas, but the index for electricity increased, and that's quite obvious with the electricity increasing, of course, with the weather becoming warmer, and there is a demand for people, using ACs or fans, keeping those electronic goods on for longer. Then that's going to be quite obvious that people are going to be using more electricity during the summer. But the other key point is that the food index continued to rise as well. So if we're looking at the year-on-year or the 12-month range for the CPI, so energy index increased 32.9%, which was a small increase compared to 41.6% in the period ending in June, or the report that we had before the last July report. The food index increased 10.9% over the last year, which is the largest 12-month increase since the period ending May 1979. And then the index for electricity rose 15.2%, the largest 12-month increase since the period ending February 2006. So I think one key thing to bear in mind is that if we're just looking at the normal CPI data, not the core data, I think we're still going to expect the food price index is going to continue to rise, with the electricity index also continuing to rise. Of course, with the summer, I still think there's this, of course, that there's going to be a lot of demand for electricity to use those electronic goods to kind of keep everyone cool during the summer and the heat wave that we've seen. So that's going to, I still think that the electricity index is going to see quite a substantial increase, which will be contributing to the CPI report. But of course, as we've seen with gasoline and energy, the energy index, and just energy in general, we've seen much lower gasoline prices in the US as well. And also, that's one thing to consider, is that is, as said in the report, is offsetting the increase in food and shelter. So it's having a bigger effect on the CPI report compared to the food and shelter bits of data. All right, then if we're looking at how does it affect the markets, and how does CPI affect the markets? So the key thing is that with the dollar, what happens is that when the economy is growing, that it tends to strengthen. And when that happens, is that the reason why the dollar was strengthened is that the Federal Reserve, or the central bank, whoever it may be, is running the central bank, then you would have the reason, if inflation does tick up and is seen to be overheating or it may become out of control, then the central bank will step in to raise interest rates. Now, when interest rates are raised, that raises the value of not only the currency as well, but also the bond yields that country provides. So because traders and investors will say, okay, I can buy up, if I put my money into dollars, I'm going to get a higher rate of interest when I go to buy maybe a loan in another country which has a lower rates of interest, so the carry trade, right? Some people, what they can do is they can use the dollar. They can use a higher rate of interest in that way to buy up a cheaper currency. So that's one thing to consider as well with the dollar. So that's why it can usually strengthen. Of course, if the economy is overheating as well, that leads to the Federal Reserve leading to raising interest rates. Stocks, so the underlying inflation, the core CPI data, is particularly important usually in a normal market and a normal environment where there's not, sentiment isn't weighing too heavily on the global market. So if it's seen as rising sharply within a month, it can lead to stocks taking a hit. The reason being is that, of course, if you see that actual prices are seeing, a sharp increase, and it's not the food and energy which is a volatile part of the release that is having a big effect on the report, and they're not seeing too much of an increase, then that can be quite a worrying sign that the Federal Reserve could step in and say, okay, the underlying inflation is actually still quite strong, and then there are other factors affecting CPI. So we need to take stronger action to rein that in. Usually, of course, whenever interest rates are raised, that means that those businesses will have to pay more for borrowing, borrowing credit, and then also paying that back as well. You've got to think about consumers, that they will have to pay more to borrow money to buy the goods or buy the services that they need. So that doesn't really bode well when interest rates are raised for the stock market. And we've all seen, even before, when we've had CPI prints before and other economic releases, when the economy has done better than expected, and then the Federal Reserve comes out with a rhetoric saying, "Hey, the economy is doing quite well, but inflation is still very sticky and still quite high, and we're not getting close to it's not anywhere near our 2% inflation target. We need to raise interest rates." So then what we've seen is the stock market and the market overall has been pricing in the strong rate hikes from the Federal Reserve. And the key factor being has been inflation, as to why they've been taking 75 basis point hikes, and the one that they're expected to do at the upcoming meeting towards the end of the month for a 75 basis point hike. So that's what happens to stocks if inflation rises sharply or much higher than expected. You expect the opposite reaction if it's lower. So if we're talking about bond yields, then, as I kind of said, when interest rates are raised, the short-term rates are where the Federal Reserve has the most control over. So when the interest rate is raised, those short-term bonds, those yields, are going to climb much faster compared to the longer-term bonds if there's a big amount of action that's being taken. So when you see that inflation print is much higher than expected, then usually we see that bond yields start to creep. They go higher, and then of course in the inverse relationship, bond prices go down. Okay, so you've got to remember that the government has got a supply and demand that has got to keep under control. They can't provide the market with low bond prices and high. They can't keep providing the market with low bond prices, high yields, or the other way. They can't say, hey, you can get a really high yield for a really cheap price for this long. They've got to try and control that. So, of course, in the expansionary phase, they're okay with doing that, knowing that the economy is on a good footing, so they can provide bonds at a low price with a high yield. But if the economy starts to falter and starts to do worse, usually what you'd see is that bond prices will go higher and the yields go lower to try and stop too many people from buying out the bonds, meaning that the government has to pay a lot of interest to those investors, people buying up those bonds instead. So usually with the CPI report, higher than expected reading leads to high yields, and a lower than expected reading yields leads to lower yields instead. Okay, so you've also got to think, again, everything that CPI has got to do with is, all linked with the Federal Reserve and what they're looking to do and what they could do. As I said, they're data dependent. They're going meeting by meeting with the interest rate decision. If we carry on then, so the economy, where is it at the moment? So non-farm payrolls, you see what we've seen from the stellar report that we had in the previous month, where we had 528,000 jobs being created, or 500,000. This month's data that we had was at 315k, and which isn't a blowout figure, but economists were expecting to see a bit of a slowdown in the non-farm payrolls data if you had the 500,000 jobs being created beforehand. Still, the economy is still on a strong footing, adding a solid amount of jobs. But as of course, as I said, it was lower than the prior release. The unemployment rate at 3.7% versus 3.5%. So we had gone from, going from 3.6% for about 4 months to go to 3.5% pre-pandemic level unemployment rate, and then the following month we tick up 3.7%. Average earnings year on year was unchanged at 5.2%. Somebody said, how do I see the data released live? So if you go to if you go to FinancialJuice live, or if you go to FinancialJuice, you can see that there. If you're a subscriber to FinancialJuice Pro, you'll see the data live, right? You won't see any delayed data if you're subscribed to it already. But I'll put the link to the FinancialJuice site if you don't have it already, Dario, but I believe you do. But I'm going to put the FinancialJuice site in there, and then the link to FinancialJuice Pro as well. That once you've gone into FinancialJuice Pro, you need to log out and log back in again, and just give it a quick refresh, and then you'll be Pro. But that's the link there for you as well. I'll pin that in the chat for you at the top. So going back to where the economy is at the moment. So you have, of course, employment costs we're at 1.3% versus 1.4%. PCE price index year on year, or the Fed's preferred measure of looking at inflation, was at 6.3% versus 6.8%. Core PCE price index year on year at 4.6% versus 4.8%. The ISM manufacturing prices paid were ticked lower to 52.5, still in the expansionary territory, versus 60. Productivity quarter on quarter was at minus 4.1% versus minus 4.6%. Import prices at minus 1.4% versus 0.2%. Export prices also down as well, at minus 3.3% versus 0.7%. And then PPI year on year are also down at 9.8% versus 11.3%. So overall, these are all the key releases to look at price pressures within the economy. So if manufacturing prices are declining, or there's a bit of a dampening of the pressures there, then that could bode well for the CPI report. Although saying that, it would have already been factored in to the forecast that we have today. If we carry on then, so the triggers then, month to month, expecting the economists are expecting, looking at a high estimate, high and low, higher estimate of 0.2% with a low of minus 0.4%, the year on year of 8.3% with a low of 7.9%. Core month-to-month high of 0.6% with a low of 0.1%. Core year-on-year with a high of 6.3% and a low of 5.8%. Okay, and then the sentiment then. So we have Russia Nord Stream 1 cutoff. So we had that news nearly a couple of weeks back now, where the Russians cut off supply, or cut off supply to Europe. And what that caused is that caused the euro to decline, the dollar to increase with the risk sentiment, with the risk environment becoming worse. And also we had seen off of the back of that is the indices also declining as well, as that Russia, something that the markets and the and everyone else globally didn't want to happen, happened, where Russia started to use the energy they provide to Europe as a way, as a tactic to try and stop the European Union and other nations to remove to not discuss any price cap on Russian energy. So that was one thing that had concerned the markets, still concerns the markets as of now, not so strong as it was a couple of weeks ago. But anything to do with Nord Stream 1 being cut off, or Nord Stream 1 coming back online, then that could sway the markets altogether, where we could see a positive reaction from the euro and a decline of the dollar if Russia says, hey, we're gonna continue with Nord Stream 1 and actually pump energy back into Europe instead. Then we have tightening, as I said, still scaring the markets. Of course, traders pricing in these mega rate hikes that the Federal Reserve has done and is going to do, but also in other areas too, the Bank of Canada, the Bank of England, ECB, right? These other areas in the major with the major economies, right, that are still having an effect on the markets. So any sort of indicator or bit of data that shows the economy is overheating, or with the CPI report, or whether it be productivity, whether it be non-farm payrolls, or GDP or prelim or advanced GDP figures for a nation, those sort of releases will have an effect on the markets, where they say, okay, that means the Federal Reserve or central bank is still going to tighten monetary policy, and maybe by a stronger amount than we were expecting initially. And we've seen that since the beginning of the rate hiking path back in March, with the Federal Reserve going from 25 basis points to 50 to 75. And it's also similar with the ECB too. They, instead of traders were expecting a 25 basis point hike, but they decided to go with a 50 when they first started raising rates in the mid this year. So then also people have been talking about the Japanese yen and whether the government is going to intervene to try and shore it up and to try and keep the Japanese yen afloat and not to kind of crash any further. So this is what we had comments earlier in the week. You had Japan's Deputy Chief Cabinet Secretary Kihara, when asked about the recent decline in the yen, that the government must take necessary measures to prevent excessive one-sided currency moves. Nothing has been provided on what they're going to do. Nothing has been said whether or not they're going to buy up the Japanese, buy more yen, try and shore it up, which is a short-term thing to try and do, because it'll provide, if they were to jump in and buy up the yen, okay, they'll provide some strength to the yen, but then they'll have to keep doing that. The reason being is that they haven't tightened monetary policy enough for traders to think we're confident in buying the yen compared to other currencies that have raised their interest rates, other nations that have raised interest rates and have a higher, stronger currency compared to the yen. So that's what so the Japanese government is within, and also the Bank of Japan is in a predicament as to, do they carry on with their monetary easing as they have done for quite a while, or do they not? Let's keep going. Then I want to kind of go through. We've got about 7 minutes. Fed view, Fed Bullard saying good CPI shouldn't affect September Fed call for 75 basis point hike. Mester not interested in looking at other readings, more interested in inflation in the services sector. Adding that one inflation report is insufficient, i.e. one decline in inflation is not good enough. We need more data to I need more data to kind of say, hey, we can slow the rate hiking path a little bit, or kind of ease off the brake a tiny amount, not go by 75. Waller said if inflation rises, interest rates will have to rise over 4%, but if it suddenly slows, interest rates could fall below 4%. Fed's Evans, indicators of inflation calling won't alter the need to reach 4% peak Fed funds rate, perhaps, but not immediately. Then we have Fed's Powell saying that at the short end, the clock is ticking and more concerns public will incorporate high inflation expectations. So the need to raise rates quickly, stop the public losing faith, and also the markets losing faith completely in the Federal Reserve. At the Jackson Hole Symposium, inflation is likely to necessitate an extended period of below 10 trend growth. You also had, when Powell was speaking at Jackson Hole Symposium, is that when he said that there is a need for restrictive policy for some time, Fed fund futures paired the early gains, and they also had dropped after Fed Powell stated that comment there. You'd also seen that the S&P 500 had declined and the dollar had started to see an increase, knowing that, okay, people who are trying to price in a cut in 2023, that's probably not going to happen. Instead, we're going to see rates that are going to be higher for longer. We're going to be in the restricted territory for longer than those traders had anticipated. Okay, UBS, softer US CPI reading might spur dollar yen correction. But so we've been above, as we've seen, we were above that 140 since September 2nd. If we're looking at ING, they're expecting a mini correction phase in the dollar right now, largely triggered by recovery and risk sentiment and some unwinding of stretched long dollar positions. I'll kind of go through here. So this is where we are. This is the image that I took yesterday. So there we go. So we are reaching a 24-year low on the yen against the dollar, and that's what we can see at the moment. Okay. Well, that was yesterday that I took that screenshot. But that's just kind of make everyone aware that the yen is being hammered by everyone, left, right, and center. Investment bank views: Citi see 8%, JP Morgan 8.1%, Goldman Sachs for the year on year at 8%, Bank of America 8.2%. Month-to-month estimates: Citi see minus 0.1%, as does Goldman Sachs and Bank of America. JP Morgan see 0%. And then here we go. Here's the prior release. We've got about 4 minutes. Okay, so you can see the markets were trying to react to the release before it had even come out. Got about 4 minutes left on the release in general anyway. So here we go. Markets were trying to react. So we had lower than expected CPI report, and there we go. Then the market started really flying after the data had come out. So what we're expecting is a lower than expected report. You'd see the dollar weaken, gold strengthen, the S&P 500 to strengthen as well. And also the bond prices just to move towards the upside as well, to strengthen. Bond prices to strengthen, meaning the bond yields will go lower. So that was the reaction there. If I kind of go a bit more forward, you can see what else. So we'd seen about on the S&P 216 ticks towards the upside. On the S&P, dollar yen had seen about 182.5 pip move towards the downside. Gold about 93 tick towards the upside, and that was the prior release. Excuse me, that was not gold. That was gold has seen 161, and the 2-year note futures had seen about 93 ticks. Okay, so we've got about 2 minutes left. Let's go to the charts then. Now, deviations, I'll quickly go through it here. So what we're expecting, if we see data that comes in line with expectation, then you would probably see a weakening from the US dollar, okay, because it shows that inflation is peaking and is showing some signs of slowing rather than going higher. If you see that the inflation data is much higher than expected, right, then what you could see is that then you'd see the inverse reaction, where the S&P, the Nasdaq, and the Dow Jones will head down, as we'd seen here, okay, where everything was much higher than expected, even by 0.2% deviation, at least 0.2% deviation the month-to-month and year-on-year. You've seen a very negative reaction on the indexes, but a very positive reaction from the dollar. We've got about less than a minute left now. Actually, we've got about 52 seconds. So one thing we're keep in mind is going to be keeping an eye on the dollar yen, as that had the biggest reaction last time around, currency pair wise, and also the 2-year note, 2-year bond futures. 2-year bond had seen the biggest reaction out of the 30-year and the 2-year. So dollar yen, we're going to be keeping an eye on, of course, the S&P, and also 2-year bond prices. Okay, if we do get much lower than expected data, then we would expect a lot of weakening from the dollar and strengthening from the S&P. Also from gold, you'd expect some strengthening with much lower than expected data. But if we do get a mix, expect some volatility here. All right, not too long left now. 0.1%, 0.1% higher than the forecast of minus 0.1%. US CPI year on year, 8.3%, 8.3% higher than the forecast of 8.1%. Core CPI year on year, 6.3%, 6.3% higher than the forecast of 6.1%. Core CPI month on month, 0.6%, 0.6% higher than the forecast of 0.3%. So data was higher than expected at 8.3% compared to the forecast of 8.1% for the year on year, and also for the month as well, month-on-month data as well. With the traders, the economists were expecting it to go into the negative territory. It didn't. We saw spot 1% instead. Now we're seeing a negative reaction from the S&P and also gold. Bond prices also seeing a negative reaction too as well. So that means the yields are going higher. Dollar is ticking up very nicely here. So let's do a quick measurement and see what we got. Okay. So, whoops. Just from my eyes, about 187 pips towards the upside there. Okay, off of on the dollar yen. So, data was across the board higher than expected. Now, the key thing to note is that it wasn't higher than the previous figure for the year, but everything else was much higher than expected compared to the prior as well. So it's only the year on year. Yes, it was higher than traders were anticipated, but it wasn't. But there was still a bit of a tick down compared to the previous figure. Still, that ain't good for the markets. Let's go through here. Let's see what else we got here. So big old decline. Wow. I believe from what I've seen so far, that is the. Oops. No. Apologies. Yeah, I believe for the S&P 500 recently, what I've looked at, the last report that we had seen, well, the biggest reaction that we've seen recently with this year, back on July 13th, we had seen 299 ticks down, but today we've seen 369 ticks down on the S&P 500. So you can imagine what the NQ is, right? So let me just show you the past reactions. So the NQ had seen 1,407 ticks down. Okay, let's go on the NQ. See what happened here. Let's see, what to do. Okay. Okay, 1,172 ticks down. Let's look at the Dow Jones. Let's look at the Dow. Let's see what you got here. Okay. That's 664 ticks down. Let's look at the 2-year bond price. Okay, so of course, as I said, bond prices have gone down, but yields have gone higher. Of course, don't forget that. The higher the bond, the lower the bond price, the higher the yield. It's about 67 ticks down on the 2-year gold. Let's see how many ticks we got on that. We saw how many ticks we saw on that. 162, around 162 there. All right, let's have a look at what I want to double check is if the dollar yen will still have the biggest reaction compared to all the other currency pairs. I believe it still would do, considering how the Bank of Japan has been easing the monetary policy and they haven't let up. So that's about 71.5 pips down. And euro and dollar yen was 185 pips up. A much bigger reaction. So yeah, okay. So, all right. Let's go through here and then GPUSD. Okay, 94 95.5 pips, about 96 pips down on cable. Alrighty. Well, that was a very that was a good release. I mean, I guess for volatility wise, if you're looking at that in the markets. So, key thing to consider if you are on somebody asked about whether they can see the live data for the CPI data on FinancialJuice. Well, on FinancialJuice Pro, right, you don't get, so I've popped in the link already that's pinned at the top of the chat, but FinancialJuice Pro, key thing is that we provide you with live real-time voice and text service on the web page here. So it's kind of, let me get text right out of the way for now. Move that stuff out of the way. Okay, so here we go. Here's the site, right? So live voice and text service that are coming in here. Fed swaps. I'm going Sean Connery mode here. Fed swaps show the terminal rate above 4.15% in early 2023, and they show a 75 base point increase for September being fully priced in. Okay, so yes, so there we go. Fed swap show 75 base point increase for September. That's fully priced in after CPI. Traders were already anticipating that anyways. Fed fund futures drop after US inflation reports. All right, so yes, so live real-time data you have here, or the FinancialJuice calendar on the left-hand side. So you have your voice feed here. You've got your live text feed here as well, all in real time. You get the data coming out for the economic releases. So one also key thing is that we have a light version of FinancialJuice Pro and a Pro version, which you're currently looking at now. The live version has adverts, has a delay, whereas the Pro version has no adverts, no delays to the sound, okay, or to the voice or text. No delays to the economic releases either. And also, if you were to put in economic triggers, let's say if you wanted to buy up the dollar, right? If you're whatever you want to trade it. So as an example, if you want to put your own economic release triggers in, so you can do that here on FinancialJuice Pro in real time as well for the data to come out. So you can select whether you want to buy or sell, if the actual is greater or if it's less than a certain figure that you're looking at. Ignore this figure here where it shows you that's just showing the forecast figure we have on the website. It's not telling you what to do. So if I said, I'm looking for 0.1%, as the actual figure, or that's my trigger to buy up the dollar, and to sell it, I'm looking at -0.3. I can save that there, and already it's there. Now, when the data comes out, it will as soon as the data comes out and it matches my trigger, it will show me a buy or sell alert here on the left hand side in real time. As said, as soon as the data comes out. Okay, that's also real time. On the light version, that's delayed. Okay, so it's much better to have access to a live voice and text feed. Consider also, just remember, is that investment banks use a live voice and text service as well to manage their trade and manage their risk as well. So why not capitalize on the opportunity there? As said, so the link for FinancialJuice Pro is tagged at the top there. Now, getting to me, or moi, if you loved or enjoyed what I had presented to you here with the economic releases, the expectation, what to kind of expect from the market, also looking at the deviations, which a lot of people have been asking for, saying, hey, is this free? Can I, can you get this in a mailing list or something? Well, yeah, it is. So not only do I provide the deviation for the upcoming economic releases for the week, but you can also have a look at the week ahead of what to expect of what we'll be covering as well. Of what we'll be covering for that week as well. So here we go. So this is what the week ahead kind of looks like for you. Of course, it's not in its formatted version in PDF, but we go through, show you, I list the releases that will be covering for the week, what to expect in the Asia session, Europe and US, and then the summary of the weekend news, what to kind of prepare for your Monday or your Sunday evening. But so that is that's also included in the for Macro Ace. So let me go through it again. So Macro Ace, we provide you the up-to-date sentiment of what to expect for economic releases, and what to expect for the week ahead, and also the deviations for the upcoming economic releases too, which is completely free in one email every Sunday that is sent out to our subscribers. So if you're asking, well, where's the link then? Well, here it is, my dudes. That is there. So, so that is there for you to have a look at and sign up to it. Of course, if you like this video, don't forget to like it, share it, and subscribe to our channel as well to stay up to date with other stuff as well. I am looking to do a webinar on market correlations and how that links with news as well, and what that means. Oh, somebody's asking, Simon Walker is saying, what is the cost of Pro? It is $99 a month. And you have also, as said, you have a 7-day free trial of that there. So have a little look, have a little play with it. As said, it's there for you. Okay. Also, don't forget. So you've been looking. If you've been if you also looking on the screen, you've also seen tick strike here as well. If you're unfamiliar with what tick strike is, well, the simplest way to put what tick strike is that it measures the amount of buying and selling momentum that there is within a certain asset or a set of assets that you're looking at, or instruments, whatever they may be, on here. So tick strike, what it does, if I kind of bring it up here too. So not only can you measure the amount of buying and selling momentum that there is in only Forex and crypto and futures and stocks, ETFs, ETNs, and also the internals as well. You can also, so what it does is that it, as said, a lot of traders, what they do and what they've kind of given us feedback is that they've said if you're a day trader or if you're scalping, then tick strike is very useful for that. Of course, you use it however you want to use it, right? There are kind of find out what kind of way works for you, but just to make sense of what all these little tickers mean here, right? What are all these numbers, Tony? Why do I see red and blue? What is this plus sign and minus sign? So keep it simple. Now, the plus sign here shows you buying momentum, and of course the negative number shows you the selling momentum that's going on. And why is it going off all the time? So you have different levels of sensitivity. So level 1 is the most sensitive to market reactions. So when there's a little movement in, let's say, the euro dollar, or whether it be buying or selling momentum, as you can kind of see here, then tick strike will go off, right, to the small little reactions that are happening within the markets. Now, if you want to see, if you only want to see big amounts of momentum within the markets, or whether it be buying or selling for, or whatever asset you're looking at, or instrument you're looking at, then you can raise that level all the way to level 15. And level 15 is the least sensitive to market reactions. So, of course, only when there's big reaction in the market, whatever you're looking at, only then will tick strike go off and show you a visual alert here. There's also an audio alert. I've turned that off for now because it'll be quite annoying and it gets very distracted hearing tick strike go off. But you can also have your own audio alert too. But there we go. That's the workspace area, or that's the platform there. You can kind of, as said, Forex, crypto, futures, stocks, ETFs and ETNs. You can also have a look at as well. So that is tick strike there. As if I put the 7-day free trial of TickStrike in here as well. There you go. That's also in the chat too. And then finally, a couple of final things. So we've also launched a new product as well called Unusual Activity. You may have heard of it. You may be familiar with it in the past. But what we've done is we've updated it. It's a brand new thing altogether now. So if you like trading unusual volume volume activity in stocks, then you can join the free beta test group of the new service. And not only do you get to look at stocks, but you'd also get to look at currencies and crypto as well, which we've recently just added to unusual activity, and then also futures as well. So that's a link there in the chat for you to sign up to that free, as said, it's a free beta test group. So we're looking for your feedback on the product itself, which will be very, very useful to us too, as we've always done with, same thing with Macro Ace, what we're doing here. If there's something that's missing or something that's not done well, or could be done better, or maybe, there could be a slight improvement that could be made, then, definitely, give me an email, which you can do with, you can do here at tony@financialjuice.com. I know there are a lot of links, but you can email me at tony@financialjuice.com. Give me your feedback, give me, let me know if it's already great or if it's already bad or rubbish. That's all those things help to make products and service much better. So that is the link there for you. Also, don't forget to follow us on Twitter as well. Show us your love there. And yeah, other than that, so somebody said, Road Idiot said, "Hey Tony, thanks for the coverage." LibZ42 said, "Good stuff. Thanks Tony." DWT51 said, "Great analysis. Thank you." I hope it did help everyone with the release and the date, everything that I did. I hope it did. If it didn't, let me know and I'll see what I can do to change that. All right, that is it for releases for this week. Next week we have the Bank of England expected to raise rates by 50 basis points, and that's more or less going to be priced in for next week. But yes, other than that, that is all I have to say. All right. Thank you very much, ladies and gentlemen. Don't forget, as I said, if you do subscribe to the mailing list, what to expect is one email with the deviations for the economic releases of the upcoming releases, the upcoming videos or live streams that I'll be doing too, and the week ahead what to expect in the different sessions. Okay? All right. Thank you very much for joining me and enjoy the rest of your day.